Why is LEO the only token that has managed to dodge the market's drastic fall? What is this token used for? What fundamental aspects have impacted its price? We'll tell you all about it here on Mundo Crypto. 1. But a lion. Unus Sed LEO. Aesop's Fable is the name given to the project launched by Bitfinex in 2018, created to compensate for an alleged loss of $850 million of the exchange's clients. This loss, according to the company, was caused by a blockade of funds by the authorities of Poland, Portugal, and the United States. To cover that deficit, the LEO token was born. With an ICO, or initial coin offering, it issued the first LEO tokens at $1 and therefore obtained $1 billion. With this money, the company behind the project, called Bitfinex, was able to cover those tether losses that had occurred on the Bitfinex exchange. The token is used to obtain discounts on the Bitfinex platform, but it also has a very special feature that we will tell you at the end of the video. The token was released on two blockchains, Ethereum and EOS. While 64% of the original supply was in the form of Ethereum, the remaining 36% could be found on EOS. Before diving into why LEO is the only token in the market that is in the green, let's carry out a technical analysis. In the weekly chart, we can see the main trend line since December 2019 goes against the rest of the market. It is evidently an uptrend with a sequence of lower lows and highs. From February 2021, the movement started to gain strength, leading us to an important overselling zone between March and May this year. In fact, it touched 93 points in the RSI. From May 2021, a lateral phase started to form, a relevant structure that created a type of ascending triangle, which tends to have a bullish connotation, especially in a bullish main structure. Towards the end of December 2021, we can see a breaking point and a pullback, which then leads to a significant volume input and an upward boost in early February. This significant movement carried out by LEO is caused by a development that we'll be covering later on. The week starting February 7th, a huge spike formed, marking an all-time high at $9.2. If we zoom in, we can see that an explosive movement of 175% took place over those 2 weeks. From that abrupt rise, it heads into a zone of lateralization or consolidation, where we can see the relevance of that upward trend guideline. The weekly timeframe also leaves us with important support on which the price has already pivoted at approximately $4.7. Another important detail to keep in mind in this analysis, we're talking about the RSI's divergence between May 2021 and February 2022. An incredibly relevant bearish divergence, although at the moment it simply boosted the regression that started on February 28th. After recovering from the regression, the price once again dropped in early May and lost the zone of lows, changing the minor structure in the weekly time frame. Now, if we display the moving averages in this weekly time frame, we can see that in this main trend line, the price has remained above the 20-period average, maintaining the strength of this trend. And something to note is that in early May this year, which coincides with the loss of the 20-period moving average, we can see that the lows of the beginning of March 2022 are also lost, resulting in a change in the minor trend. In the daily time frame, we can clearly see an abrupt movement in early February, as mentioned previously. If we take a look at the price, we can see it covered the resistance zone with no hesitation. In the daily time frame, a relevant change in the structure took place. Following the all-time high, lower lows and highs formed. Towards mid-February, the first low of that lower downtrend formed, and a descending parallel channel started to form. Once the zone of lows was lost in February, it began forming a bearish trend line, and in May 2022, volume input was seen above the average. That volume input formed a bearish candlestick, which in 2 days broke the support, and following a pullback, it once again lost the lows in a bearish continuation movement. Between May 5th and 16th, an RSI divergence formed, which prolonged until May 27th. And on May 28th is when that divergence came into play and led to an upward boost towards the resistance zone. But on June 1st, we can see a strong bearish movement, which once again tested the $4.8 zone, but the price was unable to lose the zone. And once again, an upward boost takes place, surpassing the high on May 31st. In the daily time frame, this created a range between $4.82 and $5.56. If we zoom in, we can get a better view of the 7 bullish candlesticks in the month of June. Following that boost, on June 11th and 12th, we can see a shooting star candlestick followed by a gravestone doji candlestick, which basically in the higher part of the range tends to be a bearish sign, which is also relevant in the resistance zone in which it is now found. With the moving averages, we can see the relevance of the price structure. In mid-April, the 20 and 50 period moving averages crossed each other, following the downtrend, which indicated the directionality of the downtrend. On May 5th, the trend line was confirmed when the price separated itself from the 20 period moving average and, most importantly, a relevant support zone and the 100 period moving averages were lost, marking that new low. From that moment, the 20 period moving average has been a pivot zone, rejecting the price in that average recurrently. On May 28th, it surpassed the average, and on June 1st, it lost it once again. And on June 4th, that upward boost once again won not only the 20 period moving average, but that of 52. In addition, it went on to test the resistance zone in which the 100 period moving average was found, creating those shooting star and gravestone doji candlesticks. Following this movement, a bearish candlestick with considerable volume input formed on June 13th. The directionality of those averages, without taking into account the 200 period moving average, indicates that the minor trend is bearish. The price has gone on to look for those liquidity zones created by the price zone located in that previous bullish movement. To now confirm a bullish movement, we'd have to see a significant volume input and candlesticks closing above the resistance at $5.45 and the 100 period moving average. If this does occur, the price could head towards the $6.2 zone approximately. On the flip side, which seems more likely, if we see volume input and candlesticks closing below the 20 period moving average, the price could head towards the 4.82 zone, which is the following support zone. In the event of seeing candlesticks closing below and losing the lower part of the descending channel, it could head towards the 4.5 area and co-flows with the uptrend line of the main trend. And one of the most important characteristics of this token is that it has been designed to disappear. Yes, disappear. The founding company, Bitfinex, buys tokens with 27% of consolidated income each month. And once bought, they're burned. The idea is to continue burning until all tokens disappear. As of now, LEO has about $5 billion in capitalization and ranks 14th in the cryptocurrency market ranking. Now, let's take a look at some news stories that have influenced the price movements of this token. On February 8th, the Department of Justice in the United States seized $3.6 billion worth of Bitcoin that had been stolen from Bitfinex in a hack in 2016. And this caused, as seen in the past, a significant boost in LEO's price. In a statement, Bitfinex revealed that the funds recovered would be used to buy LEO tokens and continue with the burning. This progressive reduction in the number of tokens in circulation is what leads to one think that the price of LEO will continue to rise or at least maintain itself. LEO supply is 9.5 million. On this website, we can see the number of burned tokens as well as the pending tokens to burn. On the on-chain, a burn of 44,156 LEO tokens took place on June 13th, one of the largest one-day burns since January of this year. This amount already totals to, this month, burns worth 271,000 tokens, which are equivalent to approximately $1.4 million. EOS blockchain data, which as a reminder is one of the two blockchains on which the LEO token operates together with Ethereum, reveals the transactions made to carry out those burns. Given the token is designed to disappear, it doesn't seem to make much sense for long-term investors. In fact, it was created to compensate for million-dollar losses on the Bitfinex exchange, although to justify its existence, certain benefits have been offered to Bitfinex holders, and therefore it seems that it is its only use. The Unus Sed LEO project does not have its own blockchain, and therefore its role in the DeFi ecosystem is null. What about you? What do you think about this token? Do you think it's a good idea to create a token that is designed to die? At the time of filming and editing this analysis, the market has reacted negatively, and it seems to be leading to the bearish scenario mentioned previously. The price is heading towards the $4.92 support zone, and we'll have to wait and see whether it even loses it given the relevant volume input. For this movement to be confirmed, we'd have to see harmony between effort or volume and outcome or price.